Dell has been on a phenomenal run, up 196% over the last 12 months, but after reporting their earnings not too long ago, they are now down around 25% from their all-time high. So it is now a strong opportunity to identify a very high quality company, add it to the portfolio with returns better possibly than NVIDIA. We're going to take a look and analyze this in today's episode. We're also going to talk about this company's dividend, which has been very strong double-digit increase just a few months ago. We're also going to cover some insider selling that we have noted just over the last few weeks. We'll also look towards the institutions who have in fact been buying a lot of shares of this for their portfolios. And we also want to touch upon essentially their earnings, why exactly the share price did come down, and if we can see a very strong opportunity to add this quality company into the portfolio. As always, we will talk about their top line revenue growth year on year, as well as their bottom line net income to identify any trends that we can see, as well as looking at this company's health, their total cash versus their total debt. And importantly, with this stock, we do want to run it through the valuation model. It is up considerably, so we want to understand what is the intrinsic value of today's date, what is our acceptable buy price incorporating our margin of safety, and do Wall Street still see, after a good run, some upside over the next 12 months. So let's take a look at all of this information in today's episode, and let's start off with the historical performance. Now, we do note it is up nearly 200% over the last year. If you have been a longer term shareholder, we can see over the last 5 years it is up 364%. We also know its forward P around 17.5, and it does also pay a dividend 1.31% forward looking, with a double buy rating quite high from Wall Street, 4.26 out of 5, a buy from Seeking Alpha, but we do get a hold from Quant. So let's take a look at this company and understand how their earnings were. And in fact, the headline does read that their shares did fall despite their growing AI server business. And one of the reasons, as we can see here, for the drop is that essentially Dell's AI servers aren't generating them new profits, which is concern for investors. When you do look at the likes of NVIDIA with their income streams, the data centers, they are continuing to climb, not just on the revenue side, but also improving margins as well as an increase to their profit line as well as their bottom line net income. In terms of how they performed, well, earnings per share 127, marginally better than analyst targets of 126, and also they did beat on the revenue, 22.24 billion, as we can see, higher than what they were expecting at 21.64. We also note in terms of their net income, 955 million, which is very strong, especially when you compare it to the same number from the last year, same quarter, 578. So looks very strong, although as we can see, one of the reasons that are worrying investors are essentially their data center sales. Even though that we do see a lot of growth of this, as we can see sales rising 42% to 5.5 billion. The issues that they are having here is that with the AI servers really driving that top line growth, their year-on-year operating profit was flat, which is a massive concern. Imagine their sales is increasing 42%, but their operating profit is flat. So lots to think about for this company. Let's dive in, and this will take us straight into their revenue. And what we do want to see, 3 to 7% growth year-on-year as a baseline. 54 billion reported in 2015. February 2024, their latest annual report, 88 billion. So in fact, whilst we do see growth, what you will note, there isn't a lot of consistency over the longer term. We do have periods where it is flat, as well as January 2022, we can in fact see a decrease just over the last 3 years. When we compare that to their bottom line net income, well, you will note in fact from 2015 all the way to 2019, they were making a loss, 4.616 billion in 2020, and we note 2024, 3.21 billion. So interestingly, not just the top line is a little bit inconsistent, but also the bottom line, we don't quite have that consistency that we would like to see, and that we have seen from the likes of NVIDIA, who not just grow at a very rapid rate, but also both top line and bottom line, we see that growth hand in hand. In terms of the health of this company, well, a very important aspect, 5.4 billion cash and short-term investments, 5.8 billion in terms of the more recent quarter. So very minimal movement, but we can see year on year cash does fluctuate quite significantly, and on its own 6 billion doesn't really tell us much. We do need to take a look at that total debt to understand how that compares numerically and directionally. What we can see, growth 14 billion down to around 25 in their latest report. So Cash hasn't moved too much, but we do note their total debt over the course of the last 10 years has increased, but again, similar to other balances for Dell Technologies, year on year, there is a lot of inconsistency, so we can't really spot any trends right now, and that really goes for the majority of their income statement, as well as the balance sheet that we have just briefly looked at. Of their reports, well, how do they compare? Well, what we like to have a look at is their earnings targets. What we note over the last 4 quarters, we do in fact note they have missed 1 out of the 4, so they have a 75% track record. And when you do look forwards, their next quarter, they are anticipating a low single-digit decrease to the year-on-year earnings per share. But to the future, they are forecasting for Q3, Q4, and Q1 strong double-digit growth to their earnings per share on a year-on-year basis. And if they do hit their January 2026 earnings per share estimates, the forward P will be further lower, down to 14.53. Whether or not you do believe they can hit those targets based on their past record, and you believe 14.53 is a good forward PE in the future for Dell, that is something you can look at in your own investment thesis and your own analysis. We then draw your attention to the valuation grade. Now, they do get a D-. Some of the reasons why we can look at what this highlights, well, 17.54 in terms of a PE non-GAAP basis forward looking. Now, that is a discount to the sector, which trades at 23.5. If you believe Dell is as strong as the median, you're getting a 25.35% discount to be exact. When we take a look at other metrics, for example, the price to sales, 1 versus 2.85, again, very strong in comparison to the sector. You are getting a good deal. Same can be said for the price to cash flow on both a forward-looking basis as well as a trailing 12-month. So in reality, we don't believe this D- valuation grade is fair. It should be around the B+, B+ that we can see. Whether or not you want to incorporate any of these evaluation models into your analysis, the information is clearly there. We then look at the growth grade. Now, they get a B+. Few things to note. Year-on-year revenue, we just discussed, it is very inconsistent, down around 8%. Sector median up around 3%. Forward looking, pretty much flat, 0.49%, nothing to rave about. 6.65% forward looking sector median, so that is a lot better. And when you do take a look, for example, the earnings per share, something we always like to look out for 3 to 5 years in the future, around 15%, marginally higher, around 5.27% higher to be exact, than the sector median of 14.05, but you can also see other metrics here if you want to take a look and include. So overall, for the growth, they do get a B+. We then draw your attention to their profitability grade. They get an A+. Now, a few things to note. Gross profit margin, 23%. Sector median as a whole, just under 50%. Bottom line, 4%. That is still better than the sector median, which is fairly low at 2.73. And when we also draw your attention to the cash from operations, very, very high, nearly 8 billion, with others in the sector as a whole, 91 million. Now, overall, what we talk about and conclude on this part of the analysis, a double buy rating with a hold from quant, a D- on the valuation, not something we agree with. We would say around a B+, growth B+, and profitability A+. So overall, to a good start if you do just look at these valuation, profitability, and growth metrics at a very high level. Now, in terms of how they've performed against others in the same sector, now this is essentially the information technology. We do have SMCI, HP, as well as others. Some of these we have in fact reviewed not too long ago on the channel. Over the last year, so including that dividend reinvested, Dell is up 203%, very strong as we can see, not far off SMCI, which has also had an incredible last year. When we expand this to the last 5 years, Dell, as we can see, the second best. When we compare this to SMCI, up 4,132%, a lot better. But the picture is being shown here that Dell is the second best when you do zoom out against its competitors or those in a similar sector and size. So in terms of insider ownership, well, it is very high, 46.7%, and we do see 8 insiders sell over the last 12 months, around 1.21 billion, so quite a large amount. That is a little bit scary when you do think of it. That is a lot of insider selling. When we take a look, Q2, 32 million worth of insider selling. When we look at Q1, we're talking about nearly 1 billion worth of sales. That is a very high number. In fact, the highest number we have seen. And when you do take a look at that, you can in fact see the CEO on the 20th of March did sell a significant amount of shares. We're talking 212 million. And in fact, we noticed another director, 21st of March, said a very similar amount, a large number of shares. When you also take a look, in fact, at the price that they did sell these shares, though, you could argue they have missed out on a lot of money given the share price has increased significantly. And again, this is one of the reasons why we don't always say insider selling is a bearish signal. Management don't know where the share price will go, and they can also be doing it for personal or financial reasons. In fact, a more recent general counsel did sell 12 million worth of shares, with another director selling around 5.7 million. Again, just to put this on your radar, there has been a considerable amount of insider selling, but as we mentioned, at the price, which is considerably lower than what it currently trades for, so they have in fact missed a lot of gains purely on that aspect. We then move on to the institutional ownership. 38%, we see 3.86 billion worth of sales by the institutions over the last 12 months, with a lot more buying over the same period. In fact, just in the more recent quarter, we see 1.76 billion worth of buys versus 1.15 billion worth of sales, although we do note the opposite to that in the previous quarter. But overall, not just over the last 12 months, in Q1 of 2024, institutions are buying more shares. Now, whether or not you buy this company, always do your own due diligence. Don't follow insiders, even if that means selling or buying. Always look towards your own numbers and whether or not you truly believe in the company moving forward. Now, just to let you know, we have released our latest free weekly article running through 12 undervalued high stocks, which are looking good to add to the portfolio. If you want access to this or any other articles, do click on that pinned comment below. You can gain instant access completely free. For example, and if you want to find out the websites and resources we use to identify undervalued stocks or just other articles, again, you can click for instant access below. So let's jump into this underlying metrics aspect. 70 dividend score, it does look to be safe. 1.32% yield with a market cap just over 96 billion. So it is a large cap company, and we can see not too long ago it was reaffirmed their dividend safety score, so a dividend cut does look to be unlikely. Now, in the last recession, they in fact didn't pay a dividend, so no comparative data, but we can see here negative 20% sales. That was below the S&P average during that time, and their latest increase, very nice, 20% just a few months ago, well above that minimum inflationary target. But you can see from here, they haven't always paid a dividend when we look at the last 20 years. When we take a look then, 1 year of consecutive increases, 1 year of paying without a reduction, and typically we would take a look at dividend yield theory. Now, this would show a company is undervalued if the yield sits above the 5-year average. Given the fact though they have only recently started to pay a dividend, this does become a little bit irrelevant. But what we can see, their forward P 16.2 is above the 5-year average of 8.8, so you could argue overvaluation. But remember, we don't look at any of these models in isolation, and we will conclude shortly towards the end, with the information technology, however, sitting much higher on a sector P versus Dell's 16.2. Now, we do always look at the free cash flow payout to identify whether or not this company can continue to pay the dividend, as well as whether there are strong growth opportunities. Below 60%, again, that does give us faith they can offer double-digit increases. In 2024, 18%, expected next year 31%, well below 60%, so they should continue with their nice double-digit increases. As always, on the free cash flow per share, we want to be looking at companies that are increasing their free cash flows over the longer term. They have increased it from 2015 to 2024, but even when we looked at the numbers, there was a lot of volatility and a lot of inconsistency, something just to bear in mind, as well as the fact that free cash flow is anticipated to drop into 2025. Again, we see the volatility here on the sales growth. 3 to 7% is what we want to see. In fact, 4 of the last years of negative growth, more recent year double-digit negative at negative 14%. And as we can see, over the longer term, their sales, just another format to what we looked earlier. On top of that, whilst we love companies that do share buybacks, Dell have done the opposite. They would have diluted your position as a shareholder and in fact increased the share counts by over 330 million shares just over the last 10 years. Something just to think about though. As always, this is just one part of a way a company can return excess cash. Unfortunately for Dell, they have done the opposite and diluted your position. ROIC then, we want to see 10% or more. Remember, giving us faith, management are able to effectively allocate their capital. Above 10% is my own preference. Last 3 years, they have done that. It has been increasing. Trailing 12-month basis, 25% does look very solid. So we are off to a good start. Let's just hope they are able to maintain that. As we can see, not too long ago, that we are looking at some very weak numbers. In terms of the margins, we would want to see considerably higher, above 12%. Just over the last few years, we're looking at mid-single digit, so something just to be aware of. Same to be said for the free cash flow margin. There isn't a lot of consistency here. 7% in 2024, a little bit lower expected on a trailing 12-month basis. So there are a few areas just be wary of that we would like to see Dell improve on their numbers as well as some very key financial metrics. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, we want to see below 3 for the majority of companies. Remember, number of years to pay off debt net of cash on hand. 1.15 in 2024, 1.04 anticipated next year. So no real worries about them being able to pay the dividend. Balance sheet does also look okay. No red flag indicators, but just something to think about. We do ideally want to see this consistently below 3. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we're jumping into the first model. We have Graham's valuation, the stock ticker symbol, the earnings per share, long-term growth rate with the AAA corporate bond yield to give us an intrinsic value now showing undervaluation. That's always nice to know and key in fact, but this is our first model and we don't look at any of these in isolation. We then have the multiples valuation. Now we have removed SMCI from here as we don't believe that is fairly comparable in this valuation model. We get the average P of these two versus the earnings per share to give us an intrinsic value showing some marginal undervaluation. We then move on to the dividend discount model. As we can see, they have had some nice double-digit increase, although it is just very recent. Forward looking, we've gone conservative at that 7%, and we can see a third undervaluation signal, showing significant room here with a margin of safety that we will shortly cover. We'll then look at the DCF model, the free cash flow per year. Average growth looking very high. Growth rate forward looking 6%. We've gone very conservative here. Do bear that in mind. With our discount rate at 8%, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, a fourth and final undervaluation signal. Now, the intrinsic value in today's episode is the average of these four models, coming to $166. And don't forget, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your portfolio, as well as those on your watch list by clicking below. In terms of the margin of safety, as always, we do start off with 10% and we only execute on companies if we believe it meets our 3 criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for Dell, well, it is a buy up to $150, and then we keep going till it's near the current trading price. 15% up to 141, 20% pretty much around today's value. So for Dell, we do see a 20% MOS level. And when we look towards Wall Street to see what they forecast, as we can see, Wall Street give a $165 price target, not too far off our intrinsic value. And this gives implied upside of 23% over the next 12 months, indicating, as we saw earlier, that they do believe this to be a buy alongside seeking alpha analysts. As always, let us know your thoughts in the comments below. Is this one you're looking to add? Maybe you're looking to buy it on the dip, or maybe it's now on your watch list waiting for a larger margin of safety. To me personally, this isn't one I am considering just yet. There are a lot of metrics that I would like to see improved, and whilst there are other companies in this space that are trading for a much higher valuation, I do believe some of them may be justified by the much better metrics that we are seeing. As always though, let us know your thoughts in the comments below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.